We're meeting with the European Union, and that would be actually the biggest deal of them all if we make it. I would say that we have a 50-50 chance, maybe less than that, but a 50-50 chance of making a deal with the EU. And it'll be a deal where they have to buy down their tariffs, because they're right now at 30%. And they'll have to buy them down, maybe, or they could leave them the way they are. But they want to make a deal very badly.
Wall Street likes what it is hearing. Stocks closing at record highs on Friday as trade talks with Europe and China take center stage. All this while the Fed prepares to meet over interest rates, something that has frustrated President Trump. Economist and former U.S. International Trade Commission Chief Peter Morici joins me now. Peter, Wall Street is pretty happy with the way things are going. A lot of people predicted that wouldn't be the case right now.
This is a sigh of relief rally. If you recall, the market was rallying very nicely after Mr. Trump's election on optimism that his regulatory reforms and further tax cuts and liberalization would generate more growth. And a lot of those policies are falling into place, whether we're talking about energy or finance or the high-tech sector. The constraints are off business, and they have an opportunity to innovate and to invest. But then the tariffs came, and that scared everyone. Well, now we're seeing that the tariffs are going to be moderated and mostly go away.
One of the people who said things would be very bad right now is the former Democratic candidate for president, Kamala Harris. Back in April, here's what she had to say.
Some people are describing what's been happening in recent months as absolute chaos. And it's certainly true of those tariffs. Tariffs that, as I predicted, are clearly inviting a recession.
Inviting a recession. It doesn't appear that that has come true, Peter.
No, the tariffs are a tax, and the economy has to adjust to this. Just as we've had an income tax cut, we've had a tariff tax increase. And this is slowing growth. We're going to have a slow year. We'll probably grow maybe 1.3% this year overall. And that's about half of the pace of the last 2 years. But looking beyond that, most economists see the economy picking up again, especially next spring. My feeling is this is a one-time adjustment. We're not going to have a wage price spiral, and that the Fed will eventually be able to lower interest rates, though not by a lot, because we're not that far off from where we should be anyway.
Okay, well, if you look at the GDP, the gross domestic product, quarter one was at 0.5%. And according to the numbers, estimated quarter two GDP, 2.4%. It sounds like maybe you would disagree with those numbers?
No. What happened in the first quarter is that importers front-loaded their purchases from China to beat the tariffs. And imports are a subtraction in GDP accounting. If you look at basic spending, consumption, investment, government, the usual things we look at for GDP, that was all very strong. That was really an accounting anomaly. Now, in the second quarter, we get kind of the dead cat bounce from that. In the third and fourth quarters, I'm looking at growth at about 1.2, 1.3%, average the four together, and you're at about that level. My feeling is that we're in good shape. We were bound to slow down after the last couple of years, and then next year things will pick up again, and we'll get back on what I call trend growth, which is about 2% a year.
What about the revenue from the tariffs? We've seen $125 billion in revenue into the Treasury from these tariffs. How do you value that?
Oh, that's very interesting. Over the next 10 years, if you look at the Trump tax cuts, they're going to cost the Treasury over what our policies were this year, about $300 billion a year. More in some years, less than others, but about $300 billion a year. I have worked out as best I can what these tariffs are good for in terms of revenue. And by happy coincidence, it's $300 billion a year. All this hysteria about Donald Trump creating a bigger deficit is just that, hysteria. And, the thing about it is folks in the Democratic Party can't add or subtract or multiply and divide very effectively. On Wall Street, that's what they do best. And this is starting to sink in. So my feeling is that's one of the reasons they're discounting all of this. Yes, we have a tax increase from the tariff, and we have a tax cut from what Congress, the big, beautiful bill. But over the next 10 years, as we pace through, things are going to sort of average out, and we're going to kind of stay at the fiscal policy we've been at. Monetary policy is not going to change a lot. The current level of, say, the 10-year Treasury rate at about 4.5% is really where we're supposed to be. So my feeling is that we're on a nice course here.
All right, good to hear. Peter Morici, former U.S. International Trade Commission chief. Peter, thank you.
Buy stocks.
Okay, will do.
Hey, Sean Hannity here. Hey, click here to subscribe to Fox News YouTube page and catch our hottest interviews and most compelling analysis. You will not get it anywhere else.